Let's get the Wealthy Barber's take on investing. Dave, in your first book, The Wealthy Barber, you talked about some ways that people can choose mutual funds. Now in your latest book, The Wealthy Barber Returns, you're more leaning towards index investments, ETFs and index funds. Explain to me why.
Well, it was interesting. I mean, even when I wrote the first book, I knew that the majority of money in an index fund mathematically has to beat the majority of actively managed money. It has to. It's a very simple truth. I mean, all the people trying to beat the market cumulatively have to tie it. Outperformance is a zero-sum game, so that has to be the case, but that's before costs. So after costs, the majority of the money is going to underperform the index. I thought, naively so, that I might be able to help people pick the future winners. And I thought I laid out some pretty good guidelines, looking at past performance, is the management team still in place, how are they done during bear and bull markets. I mean, I even read prospectuses. How many people do that?
Zero.
Yeah, exactly, but it didn't work. And what I've learned over 25 years of doing this is nobody else has figured out a way to predict the future winners either. Even the rating services that put all those resources behind doing it, they don't have a better track record than I do. The bottom line is some will outperform, but figuring out who they are ahead of time, very difficult to do. So you probably should slant the odds in your favor and have at least a significant component of your portfolio in index funds. And if you don't agree with that, fine, but then at least emphasize low cost actively managed funds. Costs correlate to performance. It's that simple.
So it sounds like a big part of your rationale for using index investing is the low cost, because index investments cost much less to own than conventional mutual funds. Why are Canadians so passive about trying to find low-cost investments?
Well, they are, and it's interesting that until about 12 months ago, I would say that beyond passive, they didn't even know about it. Like, they really didn't. They didn't know the expense ratio meant, where the costs were embedded, none of that. Now, in the last 12 months, have I ever seen a major shift? I've been asked more about costs in the last 12 months than my previous 21 years on the road. So I think the poor performance of the last X number of years has driven people to look a little bit differently at all of this, but also we've got a lot of competing products now getting attention. ETFs, index funds are becoming more popular. We've got the Vanguards coming to the country, et cetera. So people are looking at this and saying, hey, maybe I should pay more attention. Hopefully we're on the right trend. And again, if you want to go active, fine, but watch your costs. If you're paying 2 and 3% a year to have your money managed, outperformance is going to be so difficult. Remember, expected performance of most equity funds you hope for is 8 to 9%. If someone's taking 3% of 8, that's 37.5% of the expected return. Holy smokes, tough to overcome.
All right, watch your costs. The Wealthy Barber says so. Thanks, Dave.
Thank you.